We all saw the news come out this week from Nvidia creating a $500 billion backstop for OpenAI. I did mention in the Offside newsletter that this could create a sort of dead cat bounce for companies like Oracle and everyone else that is involved with OpenAI's ability to make good on their commitments. Now, the fact that the dead cat bounce played out accordingly makes me question whether Oracle could serve as the best example of how the AI trade could end up cracking up. And that's what we're going to get into today, starting with the one bet that Oracle made. Essentially, they bet the entire company on OpenAI's ability to repay trillion-dollar commitments, not just with Oracle, but with Micron, with SanDisk, with ASML, with Taiwan Semiconductor, and everything else, specifically NVIDIA, right? Because NVIDIA and SoftBank have so much exposure to OpenAI's ability to repay all that cash, I think we could see the reasoning behind the backstop of $500 billion happening this week. Now, the fact that OpenAI is not going to be able to pay this money, it's become clear by now. The bond market is reacting. We see credit default swaps for Oracle, for all the big spenders, really, the hyperscalers, spike. And what this means is the market is pricing in a higher probability of default on these debts, which is not great, guys. And now we move on to Oracle specifically. The same dynamic really applies to all the big spenders and everyone involved in the circular financing deals with NVIDIA, OpenAI, Anthropic. I'll just cover Oracle, but feel free to assume that this is the same setup for everyone else involved. If NVIDIA announces a stake, if everyone else announces some sort of circular financing deal for chips and memory, you could assume that this is the same setup, really. And now the blueprint is really OpenAI and Anthropic. The ability for them to meet their $5 to $6 trillion commitments, making less than $300 billion in annualized revenue, is a concern. So if those companies don't make enough revenue, with new competition, new token price wars going on, it decreases the ability of the commitments getting paid. The people that took on debt to service these companies, they're not going to repay those debts, and you can see how the domino starts to fall. Now let's start with the bond market, specifically these CDS products, right? So credit default swaps, like I mentioned, they spike when the market believes there's going to be a default event or a credit risk event. And you can see all the big spenders, right? So Oracle is leading, but you also have Google, Meta, Microsoft, and all the big hyperscalers, really, including NVIDIA, right? Because they are spending and investing most of their balance sheet into equity stakes for all the companies involved in this value chain. Now, the fact that OpenAI has recently missed revenue targets by over 90% is a major concern because they still have to make good on trillion-dollar commitments, and they're not going to do so if they keep missing these revenue targets. Apart from that, we'll get into this later, but Oracle has valued the recent data center and computing facility projects at negative present value. So where these projects used to be worth billions and billions of dollars, they're now worth negative because the revenue is just not going to come in. So they're not going to monetize on these projects. Moving on, the tell is seen in the price action after what I would say is good earnings, right? You have Alphabet, Google. We covered that earnings report in the newsletter. We made a whole video about it as well. Feel free to check it out. I'll probably link it below as well. So good amount of earnings, good amount of profit, growth in AI and compute and everything else. Yet the stock is down 8% since the earnings report. You have GE Vernova, essentially one of those quote-unquote bottleneck stocks in the energy supply for the AI supply chain, also down 7%. Then you have Intel. Intel essentially made a bunch of profits and a bunch of revenue growth that is centered around data centers and AI. Great margins, great operating turnaround. They actually made a profit on their operations after having a net loss last quarter and last year. The stock is down 11%. So what is going on? I think that Oracle itself, the debt around Oracle, the bond market, the bond instruments, they weren't downgraded because the company suddenly changed and became a bad business. I think they changed because the economics around the cash flow itself changed. So if that changes, the ability to repay debt obviously goes up in smoke. And you can see the old Oracle. They had a sticky enterprise software business that were everything from the real economy to the software economy to international businesses. They all relied to some extent on Oracle. So it was a good business. They had a predictable recurring cash flow business. They were cash flow positive. They were growing their cash flow. They were on a path to buy back shares, to eventually do M&A activity, to pay down debts, everything you want to see as an investor. By default and by nature, the debt was investment grade, self-funded. Now, the new Oracle, they made a huge leverage bet on AI capacity to fulfill on the obligations for OpenAI. Now, cash flows went negative because of all this spending and funded by debt and equity issuance. Now, the rating on the bonds is essentially relying on OpenAI solvency, which they just called for $500 billion in backstop money. So if Oracle can't even be solvent and they're on the brink of going under, how does Oracle get paid, right? And I'm not saying that OpenAI is going to go under. I mean, we all use ChatGPT and Anthropic to some extent, so I don't think that's going to happen. But the fact of the scale currently and the amount of commitments needs to go down, right? Because the economics just don't make sense. Now, we have these specific numbers of a big shoe to fill in Oracle, right? So we have a $650 billion backlog, out of which 60%, or roughly $400 billion, rely on OpenAI. So last year, they had roughly $130 billion in commitments in backlog, and now they have $650 billion. So over a five-fold increase, which is 60% concentrated on one customer. Before, everyone loved Oracle because 130 billion of backlogs was still significant. It was roughly a quarter to a half of the market cap of the company. And right now they bet over 400 billion, like I mentioned, on OpenAI, while only having a $330 billion market cap. So if OpenAI goes under or defaults on their debt, or changes the economics around those commitments, then the entire market cap of Oracle goes up in smoke. And I think that's a case that we're going to see all around the market coming up. Another important data point that I want to cover is that half of the balance sheet from NVIDIA, from Oracle, from all these companies are centered around the same bet. So we have $125 billion in new debt issuance from Oracle, negative $40 billion in free cash flow, and over $160 billion of capex deployed. So the value chain, the mechanics go like this. Oracle signs a deal with OpenAI. OpenAI signs up for that commitment. Oracle believes and has faith on OpenAI repaying that commitment. So they take on money that they haven't earned yet and take on massive amounts of debt, burn through their cash flow to build the facilities and the capacity to service OpenAI and earn those commitments. So again, this is not a problem, right? If you have a big client base, if you have a diversified client and revenue base, this wouldn't be an issue. I mean, one client stops paying, you're good to go. And if you financed these commitments and the fulfillment in an appropriate way, then there's no issue. But the problem is Oracle bet the entire company on this one project. And that's, again, no bueno. So we have the verdict now. And bond traders, specifically for Oracle, have spiked the credit default swaps past the point of COVID, past the point of 2008. And again, that is now 5 times earnings. Those earnings are not going to be realized as people thought because of the dependency on OpenAI. Now, when this deal was underwritten, it looked good because as you can see just a few months ago, the CDS products were pretty tight, so there was no risk of default because everyone bought the story of OpenAI increasing revenues and AI revenues ballooning. We don't see that anymore. So the risk of default is obviously reflected upon that fact. Now, this is obviously an Oracle issue, but I do believe it is impacting a bunch of other companies. And we just saw the money flow, the price action yesterday after the backstop money was announced by NVIDIA and OpenAI. So we have OpenAI, of course, signing commitments that can't fund, it can't meet, it can't pay off. Oracle takes on debt to build the capacity and earn those commitments. In turn, NVIDIA sells Oracle and OpenAI the chips, servers, and racks to be able to fulfill on that service. For NVIDIA to build these chips, servers, and racks, they need to buy memory from Micron, from SK Hynix, from Samsung, and then the wafers from TSMC in Taiwan. So you can start to see how one little domino, which is OpenAI, starts to trickle into a much, much bigger leverage bet. Now, after TSMC and Micron, of course, ASML needs to come in for the lithography and extreme ultraviolet equipment to manufacture these wafers and manufacture the memory chips. So, of course, what happens to OpenAI is going to trickle through Oracle, NVIDIA, TSMC, Micron, ASML, and of course the Chinese competitors that just came in, such as CXMT, such as the Korean competitors like SK Hynix, Samsung, and all the others, right? So again, we need to watch out for this trickle down effect and the ripple effect, really, and the bullwhip that this could create. So when the customer can pay, the vendor funds the customer, and this is essentially the circular financing. They used to call this vendor financing, and it was never a good sign, because if demand is so strong, if demand is so healthy and the market is healthy and everything else, why would you need to fund your customer to buy your products, right? And we're not talking about credit. We're not talking about a big order just came in, so I need to open a credit line for my customer to sell them my products, right? That's a different story. The problem here is there is no real demand. So NVIDIA has given companies like OpenAI, like Micron, like Oracle, cash injection to create artificial demand. And that is essentially what Michael Burry has been talking about. That's an issue that I've covered as well in my newsletter. So again, this is not like a credit line is being opened to buy the products. This is a direct cash injection subsidizing the demand that does not exist. So again, equity stakes, whenever you see them, think of the circular financing deals that are going on. So after those financing and circular deals, we need to look at where the skepticism should be coming from, all right? And we all should be a little bit skeptical about the projections being sent to us by these companies. So Oracle has roughly projected cloud infrastructure revenues to go from 10 billion right now in 2026 to 180 billion in 2030. So how are we going to 18x revenues in 4 years? Well, they showed you in this chart. They say that revenue from OpenAI is going to do most of the heavy lifting, and OpenAI is already missing 90% of that target. So again, the profit and the revenue targets being given to you by Oracle are going to go up in smoke. And the same thing is happening. We saw the Micron earnings and management telling you and touting really these multi-billion-dollar contracts that are not going to be filled because of these same issues. So again, don't focus on fictional demand stories. Focus on supply. Focus on actual organic demand that is happening in the market. So again, Oracle is the template. Here's how the next crack will show up in the markets, right? So we have customer concentration, not just in Oracle. We have it in Google with Anthropic. We have it in Amazon with Anthropic. We have a bunch of other companies relying on both OpenAI and Anthropic. And the fact that they can't meet their revenues, they can't pay off the commitments, are going to have the same ripple effects, right? The debts that these companies have taken on to service these AI models is going to go up in smoke. We see it in the CDS already spiking, which again, everyone that is involved in the circular financing is going to see this happen. Some companies will be less affected, some others will be more affected, right? I mean, I don't want to make any bold calls yet. I want to see how this all develops, but this is no different than a Bear Stearns or a Lehman Brothers, right? Sort of event happening like 2008. This is serious stuff, guys. I mean, we could see trillion-dollar companies just go up in smoke or face bankruptcy if they are not able to meet their debt obligations, which are now bigger than the market cap of the companies themselves. So again, something to watch out for, guys. And to finish this all off, I don't see how I could possibly or responsibly short this entire thing. But if I were to do anything, I would want to look at the rotation, right? And you can see it now. Every time AI, semiconductors, memory sells off, you could see software, halo, real economy names start to go up as well. So I've said it before, and I'll repeat it here. For every dollar that goes long the AI trade, there's probably 30 cents that goes short as a hedge on software specifically. So whenever this unwinds, you're going to see software rally, which is why I gave you Adobe, Workday, Microsoft, and Uber a couple of weeks ago, a few weeks ago now. They're all up over 20% since. In the case of Workday, big winner, 30%. So again, I'm not worried about all this, but if you look at the price action right now on the SMH semiconductor ETF, you can see it's a classic distribution on a sell-off. So we have the initial peak, the initial down move, and then a 50% retracement, which is right in the middle, that big uptick, followed by a continuation of lower lows and lower highs. So if we continue to see this, this is essentially textbook distribution. And we saw the Goldman Sachs prime brokerage data showing us that managers are dumping. Managers, hedge funds, pension funds, everybody's dumping the SOXX, the SMH. Everything that has to do really with semiconductors and memory, they're all getting dumped. And I think we see it now in the ETF with that classic distribution pattern. Now, out of the spenders, we're going to go into some of the debunked narratives, right? So we have software. Software was told to everybody that it would be the worst thing to invest in. It would be replaced by AI in a minute. It would erase all of the moats in the companies. And we're seeing AI actually benefit some of the software companies, and they're rallying by a big amount off the lows. They're back into bull markets already. So again, debunked. Mid caps. We have a specific thesis around mid caps, and I'll link it down below as well. I think the rotation has to see 3 specific economic indicators align for the mid caps to rotate. But again, these are the halo names that have most of the revenue in the US. They're AI agnostic in the sense that AI could actually amplify margins and productivity rather than replace them. So if you do believe that AI is going to take over jobs and take over businesses, then I think these mid caps in the US could be the best way to hedge, right? Now, we have another trade happening in long bonds, and I think that narrative happens once we see the cracks in companies like Oracle and whatever happens after that, right? Oracle goes under on its debt. I'm not saying bankruptcy, but defaults on the debt, right? We're going to see the term premium for long-term bonds go down, which creates a bidding market and a high demand market for long-term bonds, which is why I picked the TLT ETF. And that would also spike high yield spreads, which is one indicator that I told you about, could also give us the opening for mid caps. So you can see how it's all connected. As software rallies, we might as well see the mid caps rally as a projection of long duration bonds rallying on a lower term premium, and then yield curve shifting towards a cooler economy or a growth shock, essentially. Driven specifically by the defaults on these big companies, right? What happens now, and after all this, what's happened historically is that Chinese tech rallies. We could see it in 2025, right? When the big crash in tech came, or what we thought was a big crash. Chinese tech rallied. When we saw COVID, Chinese tech rallied. When we saw 2022, the bear market, Chinese tech rallied. So whenever bonds shift, whenever mid caps become the hotter thing, and whenever defensive software gets bid, Chinese tech gets bid. So these are the narratives that I'm looking for. Anything that happens to the AI trade, any unwinds, any sell-offs, I believe is going to have a negative effect on risk taking, and that happens to have a positive effect on software, mid caps, bonds, and Chinese technology. So this is the basket that I'm watching. You're gonna have all the names get pitched to you, all the deep dives as they already are. Some of them already in the portfolio of Upside Capital. We're up 7% on the quarter, being 52% cash. So we're outperforming all the narratives. And the buckets and the basket that I mentioned previously is starting to outperform. So again, you have the baskets, you have the themes, you have the setups, but you don't have specific companies, right? That is what I'm going to give you inside outside premium. You can sign up right now and get 50% off for 3 months, and then you pay the standard price. Check us out if you like it, if you make some money out of it, good to go. You covered a year plus of worth of membership, so you could feel free to stay after that. Again, we're gonna be giving you the deep dives and a watch list on the mid caps, on the Chinese tech, and everything else that I'm watching here. Give you the live trade execution. You'll have access to the offside community as well, so you have live alerts on what I'm buying and selling, daily portfolio positioning updates, and all the good stuff that you get with us, guys. So that's all for today. Thank you for watching. Hope to see you behind the paywall and see you making some money with us. Good luck, and I'll catch you in the next one.